The Mullen Automotive stock has been trending in popularity recently, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should be mindful of which positions to choose, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Mullen Automotive has been having a swing over the past month or so, having not succeeded in going beyond the previous resistance, but also maintaining the support level near the $1. So with that being said, what we can determine for sure is that Mullen is quite resilient in its ability to hold the line when times are tough, and that the market-wide sell-off pressure has been remaining high over the past 6 months or so. Of course, no one can tell for sure what's going to happen over the next 6 months, but I believe that the current price level, combined with the fact that the recent fundamentals haven't been very positive for Mullen, that the worst might be behind us, and that whatever is going to play out in the future, there are reasons to believe that the stock will be able to limit its downside risks significantly. The week ahead of us is important, as it'll tell us if the stock is going to hold its line and to start benefit from a very small market recovery, partially due to the sell-off losing some of its steam after so many months of downward pressure, and partially also because the federal bond yield has decreased a little over the past few weeks due to the economic uncertainty. Now, let's take a look at the technicals of Mullen. The trading volume of Mullen Automotive has recently been 61 million shares versus an average volume of 58 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.09. The trading volume is a metric telling you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first-hand idea about the popularity of a company, and we can also use it to compare with the average volume to tell us if the company is enjoying additional momentum to reverse the trend or to break through current resistance levels. Even when the current volume is lower than the average, it is an interesting indication nonetheless, because it may signify that a trend reversal could happen soon. The market cap of Mullen Automotive is currently around $355 million versus an enterprise value of $112 million. To put simply, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies might be the intangibles, meaning they're not things that we can see, touch, or use right now, but they're essentially guarantees or tokens that promise a better future, such as brands, intellectual properties, and schematics. For startups, most of their valuations are based on those intangibles, which could be valued in more favorable market terms. In concrete terms, this means that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value. So it's possible that a company itself was overvalued in the first place and only deflating back to the normal level. This doesn't really apply to what Mullen is at the moment, but it's nevertheless useful to be reminded of this fact when we see companies trading way below their book values. It doesn't mean that they're going to bounce back at least at the book value. So as we compare the current price to the historical price fluctuations, the stock is 31% higher than the 1-month low, 56% higher than the 3-month low, and 127% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to go next, the implied volatility is around 225% versus a historical volatility of 155%. The put-call volume ratio is currently around 0.15. It's normal for most stocks to have a higher put option volume than what they truly deserve, as the institutional investors tend to hedge their long positions by buying put options. The most recent volume of options traded has been 24,000 contracts within a day, compared to the 30-day average volume of 41,000. In terms of open interest, the most recent volume of open interest has been 522,000 contracts versus the 30-day average of 473,000. So the option contract is a derivative from the underlying security, giving participants the possibility to have the right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you the premiums, with an obligation to execute the contract if the counterparty chooses to do so. The put options gives you the right to sell at a strike price, and the call options give you the right to buy at a strike price. So it's often said that you can evaluate the likelihood of a scenario based on the opposite of what the mass is choosing. If there's a lot of put options, there could be a possible uptrend on the move, or that a reversal might happen if there's a lot of call options. The reasoning behind that theory is very simple. Most options tend to expire worthless because those trading options are often trying to catch a gravy train that has already gone. In terms of the shareholder structure, institutional owners hold about 1.6% of the outstanding shares. The biggest shareholders include Citadel, Vanguard, and Susquehanna International. It's relevant to understand the shareholder composition of a company, as this can help us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it could be a sign that the stock lacks the depth to justify long-term trust from shareholders. The typical consensus is that there should be at least 25 to 30% of institutional involvement for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, a lot of exceptions would apply here because there are many great titles, mostly held by retails. But that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the total volume, this could be a sign that there is an organized shorting operation going on, such as what is going on with GameStop and AMC. The short interest right now is about 11% of the total float, and 48% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short interest coming out of the dark pools, I would say that there could be institutional positions taken to short the stock, and that there would be potentials for a short squeeze. It's not really the case here, as the current short interest is only 11%. My recommendation is to commit a significant portion of your allocation in Mullen now, and to leave the rest for the next 6 months or so to write off the immediate term volatilities. I would recommend to commit between 3 to 5% of your portfolio in Mullen, and would also recommend to split the allocation in batches of 20% at a time so that you could purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.